This video is about the amendments to the Finance Bill 2023. As per the amendment passed on 25th March 2023, the long-term capital gains are removed for debt mutual fund schemes. It is applicable for investments made from 1st April 2023 and for those debt mutual funds whose equity investment in such fund does not exceed 35%. In this video, let us look in detail about the amendments and how it impacts your investment journey. Welcome to holisticinvestment.in. What is debt mutual fund? Debt mutual fund invests in fixed income instruments such as corporate bond, government bond, treasury bill, debentures, etc. Since they earn a fixed return, they are less risky than equity mutual funds. Also, it provides higher capitalization than fixed deposit. Now, let us look into the taxation of debt mutual funds. Old taxation. If a debt mutual fund is sold before 3 years, it is short-term capital gain. The gains are taxed as per investor slab rate. If the units are redeemed after 3 years, it is long-term capital gain. A 20% tax will be applicable on the gains along with the indexation benefit. Now let us look into the new taxation. From 1st April 2023, the debt mutual fund schemes will be taxed at income tax rate applicable to your income irrespective of the holding period. If you have any SIPs in debt mutual fund schemes, only investments made till March 2023 will enjoy the indexation benefit. This applies to debt mutual fund schemes including gold mutual fund, fund of funds, conservative hybrid funds, and foreign equity mutual funds. Let us understand how it affects your tax outgo with an example scenario. Let us assume you have invested Rs 5 lakh in a debt mutual fund scheme in March 2020 and it gave you 7% return per annum. Now, the fund value would be around 6.12 lakhs. If you redeem your debt mutual fund after 3 years in March 2023, earlier, after the indexation benefit, the tax payable on long-term capital gain is Rs 7,971. If the indexation benefit is removed, then you need to pay a tax of Rs 33,756, assuming you are in the highest tax bracket, almost 4 times higher than the above case. Going forward, how you should be choosing your investments. Taxation shouldn't be your only criterion in selecting an investment avenue. As an investor, you should consider all the factors like liquidity, risk-adjusted return, and other benefits before taking an investment decision. Do not just focus on the propaganda distributed by the media that the removal of indexation in debt mutual funds has made it on par with FDs. Many other factors make the debt mutual fund have an upper hand over bank FDs. As an investor going forward, debt mutual funds could be a better option than bank FDs due to the following reasons. There is no TDS in debt mutual funds. In bank FDs, if the interest income exceeds Rs 40,000, in case of senior citizen, it is 50,000 in a year, then the bank deducts 10% TDS on interest. SIP investment option in debt funds. Generally, investors allow their surplus fund to accumulate in their savings account, which make your money lie idle when it could be producing return. And then with a lump sum amount, they open a FD. But in debt mutual funds, you have systematic investment plan. Or even with irregular surplus, you can invest. Setting off the losses. The capital gains from debt mutual fund can be set off against the capital losses you made from stocks or other investments. This set-off advantage is missing in your FD investments. Liquidity and partial withdrawal available in debt mutual funds. Debt mutual funds are very liquid. Your redemption request is executed within 1 day. Also, you can withdraw as much as you want. But in FD, you have to break your deposit even if you need a lesser amount. Systematic withdrawal plan for regular cash flow in debt mutual funds. SWP facilitates the investor to withdraw money at periodic intervals. While your debt funds grow at a pace, you redeem a certain amount regularly to meet your financial needs. Tax deferment in debt mutual funds. Interest income from FD is taxed every year under the head income from other source. In debt mutual funds, the tax is deferred until you redeem your units. That is, as long as you hold the fund, you need not to pay tax. Only at the time of redemption, the capital gains is calculated and taxed. You can understand the tax deferment better with the help of scenarios. Let us consider two scenarios for your investment option. Scenario 1. You invest rupees 1 lakh under bank FD and debt mutual fund. After 3 years, your FD matures and also at the same time you redeem your debt mutual funds fully. Let us calculate what's your final maturity value under FD and under debt mutual fund. The fixed deposit interest is based on the historical State Bank of India fixed deposit rates for different deposit terms. The post-tax maturity value in FD would be around 1,14,314, whereas in debt mutual funds it would be around rupees 1,15,749. Now let's move on to scenario 2. You invest rupees 5 lakhs under bank FD and also under debt mutual fund. The interest on the fixed deposit is received on yearly basis, that is on non-cumulative option. Similarly, the same amount is withdrawn from mutual fund scheme every year. Let us compare the tax outgo in FD with mutual funds. Since it is a non-cumulative FD, every year you receive an interest amount of rupees 35,000. This is added to your total taxable income and taxed as per your slab rate. The tax outgo would be approximately 10,500 per year, assuming you are in the highest slab rate. Under mutual funds, only proportionate units are withdrawn from the fund and without disturbing the rest of the fund. Out of rupees 35,000, only rupees 2,290 is your gain and it is taxed at your slab rate. The tax outgo here would be rupees 687, assuming you are in the highest tax bracket. Similarly, whenever you redeem your units, the tax has to be paid for the respective units in the respective financial year. When you compare the tax outgo under FD, it is rupees 10,500 every year. Whereas in mutual funds, the tax outgo would be rupees 687 rupees and rupees 1,329 and rupees 1,929 in the first 3 years respectively. We would like to conclude this with our final verdict. The concession given to debt mutual fund is taken away. That doesn't mean that the total sheen is lost. The tax outgo from your side is only when you redeem your units. So until then, tax payment is deferred. If you are considering corpus accumulation for any of your short-term financial goals like a down payment for a home or etc. through your monthly surplus, then debt mutual funds could be considered a better choice among the other debt instruments available in the market. Pick your investments considering its safety, liquidity, risk-adjusted return and personal risk appetite. Do not fall into pitfalls just to save tax. As an investor, you should be focusing on building a diversified portfolio to meet your financial goals. A detailed blog post on debt mutual fund taxation is available in our website. The link is given in the description box. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.